All right, time to dive into the world of Raymond James Financial.
I'm ready when you are.
We've been poring over their 10K reports from 2020 to 2023. And let me tell you, these things are dense.
They are something else, aren't they? But they are fascinating once you start to uncover what's really in there.
Right. It's like our mission today is to decode these things and help everyone understand what Raymond James is really all about. Their business model, the risks they face, what the future might hold.
Absolutely. It's about connecting the dots and painting a clearer picture than you get from just the headlines.
Exactly. So, to kick things off, Raymond James calls itself a leading diversified financial services company, which doesn't really tell us much, does it?
It does sound a bit vague, like saying you're in the business of making money. But if we look at their 2020 10K, we see they're actually involved in a surprising number of things.
Oh, like what? I'll admit, I don't know much about them beyond the name.
Well, they have 5 main segments to their business, and get this, the biggest chunk of their revenue, something like 43%, comes from asset management fees. Not stock trading, which is what most people probably think of.
Really? So they're more focused on managing money for clients than actually trading stocks themselves.
You got it. They're more like financial advisors on a massive scale. They do have a sizable banking operation, too, bringing in about 24% of their revenue.
Huh. I didn't realize they were so into banking.
Oh, yeah, it's a big part of what they do. And then, of course, there's the capital markets activities like underwriting and trading, which makes up another 22%.
Okay, so that's the bulk of their revenue. What's left?
Well, there's this intriguing little 4% sliver they categorize as other, which, when you dig deeper, includes their private equity investments.
Private equity. Now, that has a certain ring to it.
It does, doesn't it? Sounds very Wall Street.
It does. So what are they doing with private equity? Are they buying up companies?
In essence, yes. They call it merchant banking. Basically, it means they're investing directly in companies rather than just playing the stock market.
I see. So they're not just managing other people's money, they're putting their own skin in the game, too.
Exactly. Though things got a little trickier for them with the Volcker rule after the 2008 crisis.
Ah, yes, the Volcker rule. That put a damper on a lot of those kinds of activities, right?
It did. The Volcker rule was designed to prevent banks from taking too many risks, especially with depositors' money.
And since Raymond James also operates as a bank, they had to comply.
Precisely. They had to offload some of their private equity investments by 2022 to stay on the right side of the regulations. And it's all there, spelled out in their later 10K reports. Really shows you how much of an impact regulations can have.
It's like they're always playing this balancing act, trying to grow and evolve while staying within the lines.
Right.
But speaking of challenges, their 10Ks also give us a peek into their concerns. What are some of the things that keep Raymond James executives up at night? Yeah, what are some of those big risks they're worried about?
Well, one that jumps out, and it's something everyone's thinking about these days, is cybersecurity.
Makes sense. I mean, they're dealing with people's money, right? Security's got to be a top priority.
Exactly. One data breach could be devastating, and Raymond James knows it. In their 2021 report, they actually say the techniques used in these attacks are increasingly sophisticated, change frequently, and are often not recognized until launched.
Oh, wow. So they're really aware of how serious it is.
Yeah, they even say they recognize that it's a question of when, not if, an attack might happen.
So it's not just about building a strong defense. It's about being ready to react when something inevitably gets through.
Exactly. And it's interesting because right alongside cybersecurity, they're also laser-focused on attracting and retaining top talent.
Oh, yeah, I noticed that too. You'd think a big company like Raymond James wouldn't have to worry much about finding good people.
You'd think so, but it's crucial for them. Their whole business model relies on having skilled employees, financial advisors, analysts, the people who really understand the markets.
So if they lose those key people, they risk losing clients too.
It's all connected. And that ties into another risk. They highlight the competition. They're constantly having to make sure they're offering competitive salaries and benefits to keep their best people from being poached by other firms.
It's like a whole other kind of market, a talent market that they have to compete in.
Exactly. And it can get expensive trying to stay ahead in that game. Okay, so we've got digital threats, talent wars. What about the elephant in the room? The economy.
Right. How's Raymond James viewing those choppy economic waters? We've been through a lot these past few years.
Tell me about it. And you can actually trace their evolving anxieties through the 10 cares. Like, in 2020, it was all about the pandemic.
Right. Everyone freaking out about the pandemic.
Exactly. The market volatility, the interest rate drops. They even talk about having to adjust some of their operations to adapt.
Makes sense. Everyone had to adjust.
Absolutely.
Yeah.
But then you fast forward to 2022, 2023, and the tone shifts. They're really starting to hammer on inflation, interest rate hikes, the after effects of all that stimulus spending.
Those are big concerns for any financial institution.
Huge. It directly impacts their clients' investments, and that, of course, affects Raymond James's bottom line. So they're clearly keeping a very close eye on all of that.
So they're laser focused on all that. But it's not all doom and gloom, is it? One thing that really stood out from these reports is Raymond James's growth. Yeah. Especially their assets under management, their AUA.
Yeah, their AUA has been on a tear.
It has. By 2021, it had climbed to over $1.1 trillion. That's a staggering amount of money.
It is, and it's a key indicator of their success.
Okay, so for those of us who don't speak fluent finance, break it down for me. Why is this growth in AUA so important? What does it actually mean for a company like Raymond James?
Well, in the simplest terms, more assets under management usually means more revenue. They earn fees based on the assets they manage, so the more money they manage, the more money they make. It's pretty straightforward.
Right. Makes sense. But is it just about the money, or does a big AUA bring other benefits?
It definitely has a ripple effect. A large and growing AUA can attract new clients. It can also make it easier to attract top talent because people want to work for a winner, right?
Right. Success breeds success.
Exactly. But, and you knew there had to be a but in there, managing all that money isn't without its challenges. There's a lot of pressure to generate consistent returns. If their investment strategies don't work out, clients could start taking their money elsewhere.
It's a high-stakes game for sure. And speaking of high stakes, it seems like Raymond James has been making some power moves on the acquisition front.
They have. They've been pretty active in that area, and each acquisition tells you something about their strategy.
Like what? What kind of companies have they been buying up?
Well, they bought Charles Stanley, which is based in the UK. That was a clear move to expand their international presence.
So thinking globally.
Definitely. And then there's Tri-State Capital. They're a bank, but they specialize in private banking and asset management. That tells me Raymond James is looking to attract a wealthier clientele.
Going after that high net worth market.
Exactly. And then they picked up Sumridge Partners, an investment firm that focuses on fixed income, which is a whole other ballgame.
So diversifying their offerings, expanding their reach. It's like they're playing 3D chess while the rest of us are struggling with checkers.
They're definitely strategic thinkers, and these acquisitions are not cheap.
I bet. So they're putting their money where their mouth is.
Oh, absolutely. The 10Ks show that they've poured a significant amount of capital into these acquisitions. It really underscores their commitment to growth, even in uncertain times.
So they're not just talking the talk, they're walking the walk. They see opportunity, and they're going for it, even when there's a bit of a storm brewing.
Yeah, they're definitely sending a message. They're playing offense, not defense.
I like it. Yeah. Well, this has been fascinating. We've covered a lot of ground here today, but it's clear that Raymond James is a company to watch. They're making big moves, and it'll be interesting to see how it all plays out.
Agreed. There's never a dull moment in the financial world.
That's for sure. Thanks for joining me on this deep dive into Raymond James Financial. It just goes to show you can find some pretty interesting stories hiding in those financial reports.
You just have to know where to look.
Exactly. Until next time, happy exploring.